Why are Wall Street and the government suddenly so interested in giving everyday investors the ability to invest in things like private equity and private credit, non-traded real estate, and generally alternative assets that have traditionally only been accessible by larger, more sophisticated investors? Today I'm going to talk about this asset class we call alternative assets, non-traded assets that aren't traded on public exchanges. I'm also going to talk about some of the things that aren't really always apparent, including some percolating issues in the headlines and behind the scenes in some of these asset markets that unsuspecting investors may not be aware of. So let's talk about a few things that maybe on the surface seem unrelated, but I'm going to connect the dots for you here. So earlier this month, in August 2025, President Trump signed an executive order that would open up the ability for individuals in their 401k retirement plans to invest in these so-called alternative assets. This up until now has not really been possible for a lot of different reasons. Separately, I'm going to highlight some growing concerns that we have and we think investors should have about some of these markets. So for example, the private equity industry has grown tremendously over the decade or more. And in just the last couple of years, there have been increasing headlines about what I would describe as a liquidity crunch, where investors, typically large institutions, endowments, and pension plans, are looking to get distributions from these investments at a time when the private equity sponsors, the funds that make the investments, are having a harder time finding exits of the companies that they own to provide that liquidity. Even more recently, in the private real estate market, we're starting to see some real stresses, and this is in no small part because of the rise in interest rates in the last couple of years. Just this week, there were some headlines across the airwaves regarding a fund called Yield Street. This is a fund that came out in 2015 that was meant to provide access to the masses, everyday people, for as little as $10,000, the ability to invest in non-traded real estate. And as the name suggests, the idea was a very high-yielding type of investment that would kick off recurring income. The stakes couldn't be higher. Over 90 million Americans participate in employer-sponsored retirement plans. And this policy shift could open up the pathway for literally trillions of dollars of hard-earned retirement savings that could go towards these alternative investments that oftentimes are illiquid, they can be expensive and laden with fees that aren't very transparent. Investments themselves are oftentimes very opaque, and investors don't really even know what they're getting into. On the surface, what's being sold as a democratization of, allowing people to get into the asset classes that only the top 1%, so to speak, have been able to invest in. That seems like a good and benevolent thing. But there are skeptical ways to look at this too. History is replete with examples where the financial industry has innovated products that more or less turned out to be very self-serving, to allow large moneyed interests to kind of take the money and run, so to speak, and leaving smaller, unsuspecting investors holding the bag. This could be one of those such examples. So I'm about to highlight some examples of how retail investors could be setting themselves up for a big problem, and aided and abetted by these reforms and legislation that makes it easier for investors in things like 401k plans to pursue these kinds of investments. I want you to sit back, hopefully find some value and education in this video. Please subscribe to our video. We put content out every week. And when you hit the subscribe button, make sure you hit that little bell. Only 20% of our subscribers have hit that bell. The bell is the best way to make sure you get alerted in a very subtle way when we put content out. And hopefully we'll find that you find this content timely and useful for you. So let's get back to the topic at hand. So just this month, President Trump signed an executive order. It was entitled Democratizing Access to Alternative Assets for 401k Investors. That sounds great, right? Who's not a fan of individuals having choice, being able to do what they want in hopefully a very smart and prudent way. So on the surface, this comes off with a popular sounding goal, letting ordinary Americans invest like the 1%. We keep talking about the wealth divide, and this on the surface sounds like a way to level the playing field. So let's talk about some of the provisions of this executive order. So first of all, this order would open the pathway to allow investors in 401k plans and the sponsors of those plans, the fiduciaries, the companies that sponsor these plans, to offer private equity, private credit, non-traded real estate funds, cryptocurrencies, commodities, and other things like longevity products, which are probably just a savvy way of talking about things like annuity products that allow an income stream for as long as someone should live. The order directs regulators to ease restrictions and reduce the legal risk for plan sponsors Many employers are worried about their fiduciary responsibilities, and they take it very seriously. And this would somewhat take them off the hook if they were to offer things like these alternative investments, and it would reduce the legal action that could be taken against them if something turned out bad there. Bottom line, the government wants to tear down barriers that have kept these kinds of investments from everyday investors. And again, that sounds like a great and benevolent thing, that just giving people more choice. But the reality is that alternative investments come with a lot of complexity that many investors aren't prepared for or don't understand. Things like high fees, lockup periods, not being able to get your money out in a liquid way like you can in publicly traded stocks and bonds, for example. Many times you have to lock your money up for years. And even when you get the opportunity to take some money out, it's limited to certain amounts of your investment, not all the investment at once. As it turns out, typically these restraints on liquidity kick in exactly when you don't want them to, when things are hitting the skids and you want to pull your money into a safer spot. Even the valuations themselves of these investments can be suspicious, if you will, and that's a kind word. Because they're not traded investments on a public exchange that gets valued with every trade, every second, like publicly traded stocks do, these valuations are oftentimes just accounting constructs, basically a appraiser's belief or opinion about what the value of these assets are. It's not unlike, going on Zillow and seeing that, hey, my house is worth X, but really the only way to know what your house is really worth is actually selling it and see what the market will bear. And oftentimes there's a big mismatch between this kind of theoretical appraisal of an asset and what the true market value of that asset is. These are really important things that people have to understand before even considering these kinds of things. But one key question I want to ask is, why now? After so many years of these kinds of investments not really being available to the masses, why now? And here's where I'm going to put on my hat as a healthy skeptic for our clients and our viewers. Let's talk about the private equity market. So again, private equity is simply companies that are bought by private pools of capital that are not publicly traded companies. These are companies that either never went public or were public and got taken back private. And typically the kinds of investors in private equity funds, they're typically larger, sophisticated investors, things like pension plans or endowments, for example, by colleges and things like that. Big, sophisticated investors that invest hoping to get a good, solid return, oftentimes a non-correlated return with public markets, or that's at least the theoretical goal. But the point is they need that money back. They need to spend. So for example, colleges spend their endowment on operating expenses and things like that. So they expect that the private equity funds into which they invest will return money to them so that they can use it for their mission. Now, how is that liquidity created? Well, it's by the selling of the very assets that the private equity fund invests in. So they might buy a private company, Acme Packaging, let's call it, and they might hold it for 3 or 3.5 or 4 years and build value and invest in the business and grow it and things like that. And then they'll sell it. They may sell it to another private equity fund, or they may take it public or sell it to management, any which way to create liquidity by selling that asset. And that liquidity then is the way the fund pays back a realized return on investment to its investors. And those investors will oftentimes re-up and recommit funds for the next iteration of that process, if you will. Well, right now, and there's a recent report, actually it was the 2024 Bain and Company report on the private equity market. And the headline says, have secondaries reached a tipping point? This is speaking to a specific vehicle that has evolved. But in this article, it talks about how there's about $3.2 trillion in unrealized value within private equity funds in over 28,000 unsold companies. A big backlog of funds not really being able to exit on the terms they want to. And that's created a liquidity pinch, if you will. They're not being able to sell these companies to be able to return funds to their investors to spend in their ongoing operations. That's 4 times as large as the backlog we saw during the 2008 financial crisis. And so the bottom line, though, is how do these funds create the liquidity that they're having a hard time creating? Well, I'm going to turn back to this idea of a secondary fund. There has been a growth in secondary funds that basically is a way to have these funds be able to create liquidity by even making partial sales of the holdings to retail investors, primarily smaller investors. I'd be forgiven if I was accused of being skeptical here, but this looks like an opportunity for these large investors to find retail investors to create the liquidity they need to get out of these assets. This is one where it's not talked about, but I think this is absolutely a dynamic underplay. And it really makes you question the motives here. Who's behind this, and why is it good for everyday investors if it's the big investors trying to get out of these funds at the same time? So let's talk about private real estate. We've started to see, when I mean private real estate, these are non-traded things like REITs, non-traded real estate development properties are off the exchange, they're not traded on exchange. And we have seen an increasing number of headlines and news reports of there starting to be some stress in this market. This is in no small part because a lot of real estate investing is financed through debt. With the run-up in yields over the last few years, that has created a challenge for many of these real estate investments where the cost of financing has gone up and maybe the cash flow hasn't been as good as they had planned in the pro forma analysis of that investment. And just this week, we saw a headline come across CNBC about Yield Street. Yield Street is a fund that was launched in 2015, I believe. And it was really celebrated as a way for small investors to participate in this, kind of non-traded real estate market that, up until then was really the playground for larger, sophisticated investors. And Yield Street, I think, allowed investors with as little as $10,000 to commit to this. Well, here we see a headline, and the headline is, "When Invest Like the 1% Fails, How Yield Street's Real Estate Bets Left Customers with Massive Losses." The headline says it all. I'm going to jump right to an excerpt from this article to really get to the heart of it. On its website, the startup, Yield Street, says it offers only about 10% of the opportunities it reviews, signaling its discernment when it comes to risk. But several professional investors pointed to the possibility that instead of securing only top quality deals in real estate, Yield Street may be getting ones that are picked over by more established players. There's no question you've seen deals that institutions have passed on that went to platforms because retail investors might have less discipline than the institutional ones. That's a quote from the article. And that right there is saying the quiet part out loud. It basically, while these funds are pitched as, hey, we're giving you, the everyday investor, an opportunity to play just with the big boys and girls, what oftentimes happens is you're getting the scraps. The retail investors are getting the scraps, meaning the junk, the stuff that the more sophisticated investors don't want to play with. The bigger picture is follow the incentives. The government wants to win on the scoreboard by saying, hey, we're giving everyday people access to these kinds of funds. Private equity managers and real estate managers are benefiting here by unlocking a new pool of liquidity at a time when exiting these investments has become increasingly harder. So again, this image of the big sophisticated investors running for the hills and leaving the everyday investors holding the bag does come to mind. Without pointing fingers at any one investment, there is this, I believe, this market dynamic at play, and we've seen this fail badly before. What about you? Let's bring it back to you. At the end of the day, every investment that you should consider is one that you should be able to understand. Many of these alternative investments are very hard to understand. They oftentimes come with very expensive fees. 2 to 3% annual fees plus performance fees of up to 20% are not uncommon. The key point, we think, for most of our clients and viewers is that they're very difficult, if not impossible, to sell when you need the cash. These are, by definition, illiquid investments, and it's all well and good if you have a very, very long-term time frame, but most folks have real needs for their money, and the seduction of high yields or really attractive returns on investments can sometimes blind them to that reality, that ultimately your investments are there to provide the cash flow that you need, for example, to create a paycheck for yourself during retirement. So I can't emphasize enough the risk that we see in kind of the illiquidity of these assets. And the real uncomfortable question is, are these really even all they're cracked up to be? There have been many studies that have raised question marks as to the true rates of return on some of these things. For example, in private equity, there are different metrics of return. There's multiples on invested capital, there's internal rates of returns, and there have been instances where there have been games being played with how the returns are calculated, and maybe the performance haven't been as good as advertised. Oftentimes, the performance are based upon mark-to-markets on appraisals and theoretical valuations that haven't been tested by the market. In other words, an attempt to sell the asset. So these are developments that we really want to sensitize our viewers and clients to. On the surface, great to have choice, great to be able to invest where you want to. But we really just want to highlight some of the things that concern us about these developments. And, as with any of the videos we do here, We invite any questions, give us a call, reach out to our team. Whether you're a client or not, we're happy to talk to you about this topic or any topic that's important to you financially. No obligation, of course. We're here to hopefully provide value just in educating, and that's good enough for us. I want to thank you again for tuning in here. Share this video if you'd like, subscribe, and hit the little bell icon. Always welcome your feedback in terms of the content we can provide in future videos. I want to thank you for watching today. Until next time, I want to wish you a great day.